Lecture 23 Examples of Trading Trends. In this lecture, I will discuss more examples of trading trends. Trading trends is not easy as it looks on the printed charts. Most of the time, the spikes are fast, which is followed by some sort of a pause in between these spikes, and these pauses could be horizontal channels or flags. This chart here is showing a typical uptrend that is characterized by fast bull spike that is followed by a bull flag, then another bull spike. Another example is shown here with this downtrend price action that began with this bear spike followed by a pause in the price, which is represented by this bear flag that has been broken to another bear spike. And this market behavior during trends, which is expressed by a fast spike and a pause and then another fast spike and another pause, makes it very difficult for traders to easily trade trends. Most traders feel uncomfortable buying near the high of a spike or selling near the low because it looks risky, and at the same time it requires large stop loss. But these are the same reasons why it is profitable, because if the setup is so obvious and easy, then most probably it's a trap. The best way to trade a bull trend is to buy pullbacks near the breaking point or to buy pullbacks when the price retraces to the moving average or to the bull trend line. Similarly, the best way to trade bear trends is to sell pullbacks near the breaking point or to sell pullbacks when the price retraces to the moving average or up to the bear trend line. Remember, professional traders see those pullbacks as flags that will break in the direction of the trend. Looking at this chart here, you can recognize that a downtrend was formed right immediately when this important support line was broken here. The best entry point for a short setup with low risk-reward ratio would be at the failed pullback reversal signal, which is located here. Your best stop loss would be just above the broken support line, which became resistance after the breakout. Your first profit target is based on previous low, which is not shown here in this chart, but it can be located here. And this successful trading plan is the opposite of what most ordinary traders do. Inexperienced traders usually take counter-trend trades when they recognize a trend because they see every higher high in the uptrend as a possible top and every lower low in the downtrend as a possible bottom. And they convince themselves that the market does not move in straight lines and that all moves will fade out eventually. Looking at the same price here, an ordinary trader will look for a counter trend trade here, just when he noticed this strong bull trend bar, which he considered a bullish signal. In the second leg up here, he would be more confident about his counter trend trade and most probably he will add more to his long position to double his profit. He didn't recognize that this setup is a bear flag and it is usually a trend continuation signal. And exactly at this point, the market trapped him along with other inexperienced traders and the price goes down, confirming the successful breakout to the downside. And to make the bad worse, this inexperienced trader didn't have a stop loss, and he kept his losing trade running until the loss became huge that he couldn't bear the pain. Can you see now the difference between the profitable professional traders and the non-profitable inexperienced traders? I hope you are, because it is so obvious that if retail traders just do the opposite of what they do normally, they will be long-term profitable traders. If they realize the fact that flags are more likely to be trend continuation signals rather than reversals, they will turn most of their losing trades into profitable ones. It requires only a trained eye and a little of courage to cross the line which separates losers from winners. This would be the end of this lecture and the end of this section. In the next section, you will learn about trading breakouts.